Hey! In this video, I'm going to teach you about the Keltner Channel Strategy, how it works, its strengths, its weaknesses, then we'll look at a quick back test of the strategy, and then I'll show you one or two ways you can tweak it to make the indicator more interesting. All this in order to help you become a more educated trader and investor. I'm the Augur. I'm a stock trader and options dealer. I make videos about trading, investing, economics, and finance. If that sounds like your thing, take a second to click some buttons and help me out. And without further chit chat, let's get right into it. Alright, I've gone ahead and pulled the Keltner Channel Strategy up on the screen in front of you. So the way this works is it runs off a user-defined moving average, which in this case we have it set to the default 20 with a multiplier of 2 over the 10 length ATR. So that means this chart goes back 20 bars, takes a measure for the moving average. Then it goes back 10 bars and takes the average true length of average true range of those bars, and then applies that length to the top and the bottom of the moving average to give you the top and the bottom of the Keltner Channel envelope strategy. Envelope. The common thinking of this is to actually use it the opposite of the Bollinger Bands, which is interesting in its own right, since they're going to be relatively similar measures. It always interested me that someone would look at the Bollinger Bands and be like, oh, I should sell the top of this and buy the bottom of that one, and then looks at the Keltner channels, which are very similar if you set them the same way, and says, well, I should buy the top of this one and then sell the bottom. I'm like, how'd you look at the same thing on the same chart of the similar indicator and get the exact opposite? Okay, well, let's put it this way. If you want to play extensions, you use the Keltner channel. If you want to play traces, you use the Bollinger Bands. If you want to just keep them set at the default settings, let's put it that way. So that's how it works. It'll, like I mentioned, it's very similar to the Bollinger Bands in that it's just a moving average and then a high and a low plotted against it. And the way this strategy works, so the way that most people use the Keltner channels in a common strategy, is as it moves above the top Keltner channel, people will buy it, assuming it's an uptrend. And when it moves below the bottom Keltner channel, they'll sell it, assuming it's in a downtrend. And you can see how it functions. You get a win there, you got a loss there, you get a loss there. So some of the strengths of the Keltner channels, at least when you use it like this, is you see you can get some pretty interesting trend trades, right? And those might pay off. We'll definitely have to look at the back test to figure that out. But I mean, it definitely hits some bangers every now and then. You got this, you got this one, it held all the way through that, boom. And you got that one, boom. So it's got a couple of bangers in there, and it's got a couple of losers. So the strength is that if you use it in this way, it can be a pretty effective way to trade trend. I might combine it with something else, and we can get to that in the last section when I talk about some things you can add to the indicator and make it a little bit more interesting. But as far as strengths, yeah, it looks halfway decent for trading trend, right? We can see that pretty clearly. So what's some of the weaknesses of the Keltner channel? Well, when you have it set to 2 like this, it has a pretty high chance of getting just torn to pieces in choppy markets, right? Those actually aren't even that bad. Let's see if we can find... Yeah, here you go. Look at all of these. Oh, you made a little bit of money, and you lost some money, and you lost some money, then you lost some money, then you lost some money, then you lost some money. Hey, you made money on that one. Then you lost some money, then you lost some money. Then you made money on that one. Then you made money on that one. So, you can see how when it's choppy like this, it'll just tear you to pieces, because in my opinion, if you're going to trade deviations or true ranges, just setting it at 2 is, so statistically speaking, there's a relatively high chance for it to make 2 standard deviations. Not super high. It's just a hair over 10%. However, that's on both sides, obviously. However, if you're looking at 1 minute bars, there's a lot of 1 minute bars in a day. It's going to happen a lot, right? if you have a 10% chance to trigger this on any one bar, there's going to be definitely some times where it triggers a lot. There's some times it triggers even more frequently than that, right? So I guess that's kind of the strengths and the weaknesses and how it works. This is actually a pretty good day if you trade the Keltner channel. So you had a little boom and then boom. Anyways, I'm getting off track. Let's go ahead and look at the backtest. So looking at the backtest of the Keltner, looking at the backtest of the Keltner channel, we can see that it definitely didn't work. It's also been a choppy market, but at the same time, we had 170 samples, which is decent. Just because we held, the only reason I say that, and I've said the other ones were good at 200 to 300, was once you get down to 100 samples or less, you start to throw in a little bit of the randomness in there, right? So it might not make a difference. The 170 samples, I mean, it's worth talking about. So over 170 samples, we can see basically its performance was sort of like we expected. It's a little losses, then you have big wins. Little losses, big win. Little losses, big win. Little losses, big win. Little losses, big loss. Losses, big win, big win, big win. Compared to all these little losses, the wins are big. However, it doesn't mean you made money. If we go to the performance summary, you can see the average win to loss ratio was only about 1.5. And since it was in a very bearish market, it was a little bit better on the short side than the long side, but still only 1.5. And you see your percentage profitable was 31%. If you're only winning 1/3 of your trades, you want to be winning at least twice as much as you're losing, if that makes sense. So what we're looking at here is, well, just to break it to you, it's a mean reversion strategy, and it's called, or it is commonly referred to by traders I know as rubber banding. And this is kind of a roughshod way to do it, but this is essentially how it works. You have two moving averages, or you can even use, we'll use two Keltner channels. That way it'll be even more interesting. Alright, this looks really funny looking, but let's talk about some rubber banding. So, rubber banding is using two alternating envelopes, one faster than the second, to gauge momentum as it reciprocates. So essentially rubber banding is you're taking extremes against themselves. So like, for instance, one rubber band trade would be you'd enter as this crosses up above as this envelope crosses this envelope, you're going to enter, and then it would fail as you fell back in. But the point is, it doesn't fail by much. The most you're going to lose rubber banding is the distance between the top and the bottom of the smaller envelope in most cases. And then what it does is it allows you to carry trend. So like something like this, where it breaks down here, it's like, all right, this is basically all downtrend, all this extra area here. So you probably want a separate timing indicator. This is kind of a longer term thing. So you might want a quick range cycle indicator of some sort to give you highs and lows to sell along this trend. So I'd probably call out somewhere around here, somewhere around here, somewhere around here, somewhere around here. Just like a quick stochastic or something. Same thing here. You can see this actually one was really clean. It fell, it crossed out from below there. It's in the extension area here, and it rides that all the way down. And when the price gets back up into the band at some point, that would be where you get out. It's very much a momentum strategy, and at its heart, it's a mean reversion strategy. You often see that these come up to the prior high of the slower band, if that makes sense. So you can even do it that way. I've seen people who will, like, as it crosses out of here, they'll trade it to the bottom of this. As it crosses out of here, they'll trade it to the top of this. As it trades out of here, they'll trade it to the bottom of this, if that makes sense. There's a bunch of ways you can use rubber banding. It's actually it kind of takes advantage of the fractal nature of the market. Basically, for the big band to be moved, the little one has to start going first from both directions. So in most instances, this will give you it is a very clean way to read trend, right? And it's kind of hard for me to explain, I guess, but yeah, there's a million ways you can use something like this. So that's my favorite. Oh, that's a beautiful one, huh? Look at that. That's my favorite way to modify something like channels. Personally, I use a sort of channel, the kind of volatility defined channel that I plot with some pretty interesting math, but there's still, at its heart, what I do is a very similar concept to this rubber banding method, but mine is, I use a lot more code than just two equations. I wish mine was two equations. So yeah, I hope you enjoyed that. I hope you learned something. This is actually like a secret of the pros. No one's teaching you. Hey, thanks for watching. I hope you enjoyed it. if you haven't already done the clicky thing to help me grow, go ahead and do that for me, and then check out my other technical analysis videos. And I hope you have a great one.